All right, let's go ahead and get started. By the way, today is Monday, February 3rd, 2 p.m. section. This is being recorded for posting. All right, so what you've been working on is the key value driver exercise. And again, there's about 5 scenarios that if you understand these scenarios, you have a good idea understanding anything relative to value creation, whether it's in this class or even in the real world, right? Because these are the underlying dynamics, right? So let's start going through some of the scenarios. So the first scenario is I ask you to take these two companies and to increase the expected profit, 200, 300, etc. When you did this, what happened to the value and what happened to the multiple? Yeah.
Value increased by the amount you increase it. So when you double the expected profit, value doubled, and multiple remained unchanged.
Okay, great. And so what this represents is what I would call sizing. So one way to become more valuable, just make more cash. You're just bigger. Okay. You're not better, but you're bigger. And that is a path to creating value. Right. Now, the next scenarios are around better. Right. And what he pointed out is the multiple didn't change when you got bigger. Right. So profit and multiples are not necessarily the same thing. So what's going to drive the multiple? What's going to drive better? Why would I pay more for those profits and cash flows? Right. That's where we get into the next series of scenarios. So the next scenario, I asked you to change the long-term growth rate. Now we're dealing with perpetuities here. So we say long-term growth rate. This isn't the 1-year growth rate or 5-year growth rate. It's the forever growth rate, 30-year growth rate, right? So when company A's growth rate increases, what happens? What happened to value? What happened to multiples? Yep.
No change to
I'm,
either.
I'm sorry.
There's no change to either
Why?
because there's zero spread.
Yeah, no change because he said there's zero spread, right? Because essentially it's a bunch of zero NPVs. And if you do a bunch more zero NPVs, you get zero NPV, right? Because A is borrowing at 10, they're making 10, pay off the 10, there's nothing left, no value being created. What about company B? What happens when they increase their long-term growth rate? Is it different? What's different? Yeah, in the back. And when there's a positive spread, because the ROIC is greater than the WACC, then it becomes exponential. You borrow 10, you make 20. The more you do with that, the more valuable you become, right? Basically, company A, I like to call the treadmill, right? You run really fast, you don't go anywhere, and you just get tired, right? Company B, what Boston Consulting Group used to call the stars. That's what we all in search of. These are the ones that are the true value creators. These are the NVIDIAs of the world, the Apples of the world, grow a high spread, create lots of value, right? And we have to differentiate between the two. Why we can say that there's good growth and there's bad growth, right? Company A's growth is not good growth, right? And in a way, you're kind of growing for growth's sake. You're not creating value with the growth. And that is not very value increasing. That's what I call the treadmill, right? Just remember those two scenarios. Third scenario, take company B, high growth, high return, and watch as it matures. So it still makes a high return, but the growth rate starts to slow. So 7% growth becomes 5%, becomes 3%, becomes 2%. What's happening here as the value and multiple both compress is an example of the expectation cornerstone. Right? I price you as if. I price you as if you're making 20 cents a year and you grow 20 cents a year at 8% per year. I realize I was too optimistic. You can still make 20% per year. You're just not going to grow it as fast. Well, guess what? That's worth less. And this is what you see with mature companies. Their value goes down, their multiple comes down. It's not that they're bad, it's just they're different stages of their life cycle, but they just don't have the growth anymore. So we would call these cash cows. Okay, you milk your cows, right? They generate a lot of cash, but they don't really have a lot of good growth prospects. Final scenario, when you reset everything, what happened when company A had a negative spread and increased the growth? What's going on here? What's the scenario? Yeah.
You're losing value
Why?
because the WACC is greater than ROIC, then every time you're growing, you're taking away.
Yeah. And the faster you grow, it's like you're throwing money away at a faster rate. Right? They used to call these the dogs. Right? Now I would just call it the black hole. You just throw money away. Right? So if you borrow 10, you make 8, just doing more of that just makes the situation worse and worse and worse. Right? So when you're in that situation, watch what happens when you shrink the growth. 5, 3, 0, -3. Avoid. Right? Harvest. Shut down. Sell off. Right? Don't keep going after the bad projects. It doesn't help you. Now, that doesn't mean I'm investing now for a low return that's going to pay off later. That's a different story. But if I don't have any hope long term creating value, then that's just pure value destruction. And I'm telling you, anytime you see a decision, one of these scenarios is going to play out, and you're going to understand what should happen. Okay? So, for example, today, Trump initiated what the Wall Street Journal has called the dumbest trade war ever initiated in the history of the world. Quote Wall Street Journal. Okay. Decided to put giant trade tariffs on Canada, Mexico, China. Anybody else, he has this fantasy, will bow to his will. Okay. So, what was the impact of the market earlier today? What happened to the stock market? Yeah. Why? In the context of these scenarios, what scenario just played out? Potentially 30 days. But what was the general impact? What scenario was the market reacting to when it started to sell stocks? What's the impact of tariffs? Yeah. Potentially risk goes up, so it's going to potentially lower the spread, and expected profits are going to go down. Companies are going to absorb some of those costs, right? And inflation, and probably a little less growth at higher prices. So I'm saying if you have less growth, less return, well, guess what? It should be no surprise stock prices went down. Key value drivers. And I'm telling you, read any headline, and you can start to think about, okay, what's probably going to happen here? Think in context of the key value drivers. You're going to see one of those scenarios play out. Questions? All right, so there is a last scenario. All right, this one's more sophisticated. What happened when the cost of capital goes down? What happens to the value and why? Yep. And because you're borrowing at a lower rate, the cost of capital, less risk, why does the value go up? Why is there higher NPV? It's not just the denominator, it's time value money. Okay. So when you discount things at 10% and you discount things at 8%, discounting cash flow at 8 is worth more than 10. Okay. So that's the other driver here, cost of capital, right? Because it does affect discounting and therefore will affect valuations. All right. So look at this. Let's say company A is a zero spread. ROIC goes to 12. Cost of capital goes to 12. Zero spread. Value goes down. Because all things being equal, when you start discounting things at 12%, they're worth less. Even if you have a zero spread. Same thing. 8, 0 spread, less ROIC. But still a higher multiple than you started with because an 8% discount rate is worth more than a 10% discount rate. And this is what people often will overlook, but is still a key driver of the market. So go back to October, November. Stock prices were doing pretty well. Part of it is there was an expectation that inflation was under control and the Fed was going to keep lowering interest rates. Look what's happened in the last 60 days. Fed said, nope, not lowering interest rates anymore. And the yield in the 10-year Treasury went from 400 basis points to 450 basis points. Why? Expectations of inflation, not going down, going up. Interest rate tied inflation, because there was an expectation that the dumbest trade war ever started in the history of mankind was going to be started. And it's been doing that. And tariffs lead to higher prices. That's inflation by definition. And that's what's upset the market. And that's why the market has been much more choppy recently. Just play it out, raise your hurdle rate, lower your values. Nothing else changes. All right, so key value drivers. Remember this, not only this semester, but beyond. This is critical to how valuation works. Questions? All right, back to our slide deck. Where we left off last week, as I said, there's some math behind the 4 cornerstones. This is the key value drivers. This kind of summarizes all the math. At a high level, it's 3 things. We just did it. Spread, ROIC versus WACC, growth, and what I'll call sustainability. How long does your advantage last? How long does the return last? Nothing lasts forever. How long does the growth last before it starts going lower? Okay. So behind return investment, 2 additional drivers. 1, margin, how much you make when you sell something. 2, productivity, how much you spend to generate sales or revenue. Those 5 things are the math behind value creation. Margin, productivity of investment, risk, growth, and competitive advantage. That's it. Those are the most important things when it comes to value creation. And you'll see them playing out this semester in the real world. All right, I want to get a little bit more detailed about some additional definitions. Let's say we have a made-up company that makes $100 million a year of operating profit after tax. The acronym is called NOPAT, Net Operating Profit After Tax, EBIT after tax, practically. McKinsey calls it NOPLAT, Net Operating Profit Less Adjusted Taxes. They're the same thing. NOPLAT, general term, NOPLAT, McKinsey's term. But the idea is you have your operating profit after tax. In this case, we make $100 million. There are 2 things you can do with that profit. As a company, you can either reinvest it or you can pay it out. The percentage of the profits reinvested is called the reinvestment rate. The percentage of the profits paid out is called the payout rate. Okay. These 2 ratios have to add up to 100%. Okay. In this case, 50-50. This company which makes $100 million is reinvesting 50 and they're paying out 50. Now, we can overcomplicate this. So when companies say reinvestment, they can say, oh, I'm doing capital expenditures, I'm building inventory, I have more accounts receivables, I can do M&A. That's just reinvestment. I pay dividends, I buy back stock, I pay off my debt. That's just payout. Okay. So the point is, those are the 2 things you can do. In a simple example, 50-50 split. Okay. Continuing, I want to define 2 more terms. G, also known as the sustainable growth rate, and free cash flow. So let's start with G. Sustainable growth rate is the rate at which you can grow with internal funds. Sustainable. So this company, which is reinvesting $50 million from the last slide, let's just assume it makes a 10% ROI. 10% historically and 10% going forward on all new investments. Keeps the math easy. If they earn 10%, and they reinvest 50, well, 10% of 50 is 5 million of new profits. If the core business keeps making 10%, keep making 100 million, 5 million in new profits, company makes 105 million next year. That's what's at the bottom right table. This is mechanically how you go from 100 to 105. Here's the shortcut. This is the formula. The formula for G, growth in profits, is you take your reinvestment rate and you multiply it by your ROIC. So if I'm reinvesting 50% and I have a 10% ROI, 10% of 50%, so that I can grow 5% a year. That's just the shortcut. Everybody understand that? So reinvestment times return is growth. Now, I also want you to understand an assumption that's made that we don't always explain why we're doing it. We're going to use growth in sales and growth in profits fairly interchangeably. Because if the margin doesn't change, growth in sales and growth in profits grow at the same rate. So that's just an assumption people use. That's why they'll often use growth in revenue as a proxy for growth in profits, because they're assuming constant margin. Now, if the margin is not constant, then growth in sales does not equal growth in profits. Growth in profits equals growth in cash flow. Assumption, level of reinvestment is the same. If the level of reinvestment is the same, growth in profits equals growth in cash flow. If the level of reinvestment changes, growth in profits does not equal growth in cash flow, right? But that's why people often say growth in revenue, growth in profits, growth in cash correlated, because they're assuming constant margins and they're assuming constant levels of investment. Okay. Now, here's the next key point. Let's say you want to take this G, the sustainable growth rate, from 5% to 10%. How do you do it? How do I get my G in this slide to go from 5 to 10? What are my options? Yeah.
Reinvestment rate?
To what? Reinvest 100% at a 10% ROI, you can grow 10% a year. Now, that may not be popular because suddenly that dividend goes away. No more dividends, no more stock buybacks, but you could do it. Or what's the second option? What's my other option for cranking up my G? Yep.
Increase return on investment to 20%.
Yeah, just overnight, take everything we do and double its return. Snap our fingers. That's easy to do, right? But at 20% ROI and 50% reinvestment, you can grow 10% a year. But what matters is that's the point. There's two ways to increase your growth rate. One, spend more. Two, increase your returns. The other concept I want you to understand is called free cash flow. A company is not worth the sum of its future profits. Say that one again. A company is not worth the sum of its future profits. Here's why. Buy a car, any new car, right? Keep the car for 10 years and don't do any maintenance on the car. I'm telling you, the car is not going to make it 10 years. Well, the same is true with a company. We can't take our profits and pay it all back because just like a car, we got to maintain the company. We're going to throw some cash back in to maintain what we got, or it's going to start to crumble. And if we want to grow, we're going to take some of those profits and put it back in to allow us to grow. So you can't pay out to investors your profits because you're reinvesting some of those profits. What you can pay out is the profit after the reinvestment. Problem is, there's no accounting term for that. Nowhere in GAAP, nowhere in IFRS does a number represent profit after reinvestment. So we, the finance people, create our own term for that. It's called free cash flow. Free cash flow, simply that. It's profit after reinvestment. That is the theoretical payout rate. That's what you can pay out. And if you forecast it, that's the value of a firm. Company's worth the sum of its future cash flows. Free cash flows, not its future profits. Very important evaluation. Questions about that? Now, the concept is very straightforward. Challenge is in practice figuring out the free cash flows because the accountants don't do it. And they do us no favors with the accounting statements they publish. So we have to convert all those accounting statements into a free cash flow statement. And it's not easy to do. You will learn how to formally do that this semester, and that's the second part of this class. Okay. But even in the real world, say you know how to do it, it's still not easy to do because our accounting systems weren't set up to do it. So here's the point. ROIC is the shortcut for free cash flow. That's McKinsey's approach. Free cash flow is key to valuation. Free cash flow is hard. ROIC is the same thing. ROIC-based valuation, which is free cash flow valuation. All right, but it's a little bit easier to do. Next slide. So this slide represents the case study you just did. That was the data on this slide that started the Excel model I gave you. Okay. And using the key value drivers, we valued it. So we said, okay, we got two companies, A, who we just introduced, and B, appear. And the whole point was A and B make identical profits. 100 million a year, 100 million a year. A and B have identical growth rates. 5% a year, 5% a year. A has a 10% ROIC. B had a 20% ROIC. They both have a 10% WACC. If we go back to our spreadsheet with that data, which is where you started, B was clearly more valuable than A, had a higher multiple. Why? Yep. I'm sorry? Yeah, the only difference is right here. That's it. B has a higher spread. But I'll say a different way. At the same risk, higher ROIC equals more value because higher ROIC equals more free cash flow. 10% ROIC means you're generating 10 cents of cash per year. 20% ROIC means you're generating 20 cents of cash per year. If you make 20 cents of cash per year and I make 10, you're going to be more valuable. And that's what this math said. Pretty straightforward. But that's what the key value driver shows. Now, back to the detail. On this slide, without doing the spreadsheet, which of these two companies, based on the data on the slide, was going to be more valuable and why? Yeah.
Company B, ROIC is 20% and has a WACC of 10%, which is 10%.
Yes, but there's something even more fundamental. Yeah. Yeah, company B generates more free cash flow. Okay, so we see that? Same profit. Company B generates more free cash flow than A. Values based on free cash flow. B will be more valuable. Okay, but I want to relate something else he said. Why does B generate more free cash flow than A for the same level of profit? And the answer is because they don't reinvest as much. They reinvest half of what A does. So for the same profits, less reinvestment, more free cash flow. The reason they don't have to reinvest as much, 20% ROI, because they're better at what they do. So assuming they're not cutting corners, B does not have to reinvest as much as A with the 20% ROI versus 10% to generate the same profits. Or let's say B reinvested 50, not 25. Well, at a 20% ROI, 50 in reinvestment is 110 in profits. They'd have more profits and therefore more free cash flow. So what I'm showing you mathematically is that ROIC equals free cash flow. Has to be. If you have a higher ROIC, you have to have more free cash flow. Because one of these two things is going to happen. You either spend less to generate the same profit, or for the same investment, you will make more money. But either way, you will generate more free cash flow and you will be more valuable. And the caveat is at the same level of growth. At the same level of growth, higher ROIC is more free cash flow, is more value. The trick is in the real world, growth isn't always the same. And so what matters is the growth return combination. That's valuation. That's it. That's all it is. Give me the growth, give me the return, give me the risk, and I'll tell you your share price. Any company. So let me show it to you. Where's Excel? All right, here's Excel. And what I'm going to do is just quickly, my Zoom window is in the way. Open up a new spreadsheet and make it a little bit bigger. All right, if we have a company, 10% ROIC, 20% ROIC. Practically, they make 10 cents a year, they make 20 cents a year. If that continues, a company making 20 cents a year is going to be worth more than a company making 10 cents a year. It's pure ROIC. Okay. But growth comes into play. So I'll make it a little closer. 15 cents, 10 cents. Same thing. You have 15% ROIC versus 10, you will be more valuable. Okay. But I'm going to add growth to the mix. What if, starting in year one, this company's growing at 10% a year? So I take 10 cents and I multiply that by 1.1. That's their long-term growth rate, 10%. Company making 15% has a long-term growth rate of 2%. So I take 15 and I multiply by 1.02. Watch what plays out over time. Somewhere around year 6, the company making 10%, growing at 10% a year, ends up generating more cash than the company making 15 cents, growing at 2% a year. And the more it goes out over time, this is the 10% company, this is the 15% company, because the growth rate is much higher. Growth, return, combination. That is value creation. Questions? So with this data, how do we value a company? Back to key value drivers. So in our spreadsheet is PowerPoint. Here it is. Too many icons. On the next slide, we're going to value A and B. So the difference between a project and a company is projects end, and companies are assumed to last forever, right? Or at least a very, very long time. Well, to value a company very long term, I use something called a perpetuity. At the bottom of the slide is something called the growing perpetuity. It's exactly how you value companies long term. Tell me what their cash flow is. Tell me what their cash flow divided by R minus G. Tell me what their R is. Tell me their cost of capital. And tell me their very long-term growth rate. You give me that, I'll value a company long-term. That's what is used. That is what's taught in the textbooks. That's what's used in the real world. That's what you learn here at Smith. And that formula that we all use has a flaw, right? I'd argue there's 2 flaws. One is we're kind of oversimplifying the entire future of a company to these 3 numbers. Get over it, we do it. But the real flaw is this. That formula assumes that the IRR on incremental cash flows is the same as the IRR on historical cash flows. Translation, whatever return you make now, you make forever. If I apply this formula to NVIDIA, has over 100% ROI last year. They're going to make 100% ROI plus into perpetuity. That is unrealistic. It will overvalue NVIDIA. If I apply this to Ford, as you saw last week, is about a 3% ROI. Because you can make 3% forever at Ford. They'll never improve their business. I think that is also highly unlikely, which means we're likely to undervalue Ford. So the formula we use that we're taught to use by the textbooks assumes whatever return you make now, you make forever, and you can't change it. And that's what we use. So here's where McKinsey said we can do better. On the next slide is a rearranged growing perpetuity. The number on the right, the formula on the right, is a growing perpetuity. The major difference is they made two substitutions. Starting with the growing perpetuity, cash flow over R minus G. Cash flow is free cash flow, which is profit times 1 minus the reinvestment rate. Substitution number 2, growth is investment rate times ROIC. Therefore, investment rate is the growth over the ROIC. So the formula on the right is a growing perpetuity. But notice in the formula on the right, ROIC is part of the formula. That ROIC is incremental, which means, using the McKinsey version, called the key value driver equation, we can have a different ROIC in the future than the past. In the original growing perpetuity, you can't do it that way. That's the formula we're going to use. That's the better version that's now used on Wall Street. That's in the valuation book, right? Now, it's one ROIC for the entire future of the firm, but at least I can make it more representative. Questions? Yes.
Can you explain again how, if you have higher ROIC, why that would increase cash flow?
Because if ROIC is a proxy for your cash flow, 20% versus 10%, then a 20% ROIC means you're generating 20 cents of cash per dollar per year. A 10% ROIC means you're generating 10 cents of cash per dollar per year. And so a higher ROIC is reflective of more cash flow, specifically more free cash flow. Does that kind of conceptually make sense?
Yeah.
All right. So we're a couple minutes ahead of where I was in the last class. So I'm going to throw this on the video. This is the fourth section of the class. Okay. So recently, I was doing work with a company called Accenture. And today, Accenture share price is $386 a share. Okay, trading in New York. I want to explain that share price. I'm going to do it with the key value driver equation. Okay. So I know, if I'm trying to understand the share price of Accenture, I need to know four things. So column E, ACN, Accenture. ACN. All right. So first thing I need to know is their expected profit. Now, if I talk about share price, that's based on net income and earnings per share. So it's the equity value of the firm. So when I say expected profit, if I say NOPAT, what I'm actually saying is the operating profit. If I say net income, I'm just saying the income to shareholders. I can use the exact same formula, though, and do a share price. So when I say expected profit, expected net income. All right. So for Accenture, right now, EEO, Accenture in 2025, actually, I'm going to do 2026. One of the things you're going to learn is we use forward multiples, not historical multiples, because historical multiples are based in the past and cash flow is based on the future. So forward multiples are more predictive of value. Number two, second year forward and beyond, things get more normalized because 2025 is a dirty year. What I mean by that, January is done. So there's 1 month of actual and 11 months worth of forecast. It's cleaner to use 12 months worth of forecast. So 2026, also known as forward year 2, is usually more indicative and used by the pros. So in 2026, first 12 month of forecast, Accenture's net income, $8.807 billion. So in their formula, 8807. All right, expected ROIC when you do a share price, becomes return on equity. Okay? Because return to just the shareholders ignores the debt. That's the share price. Okay? So instead of ROIC, we look up ROE. For the next 4 years, Accenture's return on equity, 27%, 26, 25, 23. Right. I'm going to say longer term is probably closer to 23 than 28, 27. So 23 and a half, somewhere in that range. Okay. Accenture's long-term return on investment. Today, if I type in Accenture's WACC, Accenture's WACC today is estimated by Bloomberg at 8.1%, and their cost of equity at 8.3. If I do share price, which is based on net income, I discount an equity cash flow with the cost of equity, not the WACC. So essentially, cost of capital, 8.3. What our value formula says, with no growth in these numbers long term, Accenture would be worth 106 billion, and they would trade at a PE of 12. Now, that assumes no growth. Accenture is going to grow. Okay. And by the way, Accenture's PE next year, based on today's share price, EEO, here's PE. Price per share, 386. Earnings per share, 14. Take 386 divided by 14, expected earnings. PE next year, right down here, 27.56. That's the forward PE of Accenture today, 27.56. Okay, based on 2026 earnings. So here's the point. Accenture share price has an actual PE at 25.6, 27.56. Our model with no growth said it'd be 12. So what is the market expecting for Accenture's G? We start putting numbers in here and iterating. Or we can use Excel to goal seek it. So tools, goal seek. Excel, set the multiple from our formula to be 27.56 by solving for a long-term growth rate. Right now, the G the market's using for Accenture today, where'd it go? Tools, goal seek, set the PE, was that 27.56? Changing the growth, and the answer is 5.5%. At a 5.5%, 5.52% G, the model says we should trade at 27.6 PE, and right now Accenture's PE is 27.56 next year. We just matched it. That would suggest Accenture should have a value, shareholder value, of 242.7 billion. If I go to Accenture today, DES, share price times shares outstanding, share price times shares outstanding, 625.5 million, gives them a market cap equity value of 241.7. And our model says 242. It's cash lying around, a couple miscellaneous assets, but that's the point. That's their share price. Key value drivers. By the way, if Accenture could start growing at 6% a year or 7% a year instead of 5.5% a year, long term, 7, their share price would double. 7% growth versus 5.5% growth, doubling the share price because of compound. They grow at 6% a year. Their share price would go up by 20%. Accenture has lower growth, 4%. Their share price would fall by about a third. Accenture sees its ROI change, 23% to 20. Share price would go down a few percentage points, not much. Key value drivers. It's a preview of where we're going with this. This is DCF valuation. This is multiple analysis. But there's math behind it. And these are the core principles we're going to be using this semester. Questions? Yes.
Just show how you did the tools again to solve the 5.5%.
So this is what I said. You got to know how to use Excel. If you don't know how to use Excel, you're going to learn. So one of the things you're going to learn about Excel is there's a feature in Excel called goal seek. So I can come in here and I can say iterate 4, 4.5, 5. And if I try to get these two numbers, I'd eventually get there. Or option B, let Excel do it for me. It's called goal seek. So with goal seek, you go to tools, goal seek. And what it says is take a formula, E9. I want that formula to have a specific value, 27.56. And I want Excel to solve for that specific value by iterating cell E3, the growth rate. So when I say enter, Excel is going to keep plugging in G's until those two numbers are exact. That's called goal seek. Faster. Okay, you'll be using this a lot this semester. Other questions? All right, did everybody sign the sign-in sheet? Make sure you sign the attendance before you leave. We're going to pick up here on Wednesday. Okay, so again, if you're not in a team, you have until the end of the day to get in a team. Yeah, I'm going to start putting people in teams at the end of the day. Right? On Wednesday, your first group project starts, which is called the Bloomberg Trading Challenge. Okay, so we'll talk about that when you're back on Wednesday. Have a good day. See everybody on Wednesday.